Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Comcast.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. With Comcast, the whole investment thesis really boils down to one core idea.
Okay.
You've got this company with incredibly resilient free cash flow, and at the same time, it has these diversified growth drivers that are not tied to its legacy business. They're already working.
Right. It's this kind of hybrid. It's an infrastructure company that also happens to own theme parks. It's a fascinating mix.
It is.
But let's start with that foundation, the financials. Because in a sector like this with so much capital spending, cash is it's everything.
It's king.
And looking at the Q3 2025 results, revenue was around $31.2 billion. That's up about 3% year over year if you take out the Olympics effect.
And they also beat on EPS, came in at $1.12. So, those numbers, they confirm the core is stable. But the really compelling figure, the one you have to watch, is the free cash flow.
The FCF.
Exactly. That's the war chest. In 2024, their FCF jumped over 19%. We're talking $15.49 billion.
Okay, so for anyone listening who's maybe newer to this, why is a 19% FCF growth in a mature business like this? Why is that such a big deal?
Well, it signals immense flexibility. When you're generating cash that fast, it means you can comfortably fund everything. Upgrades, investments, and returning a huge amount of capital to shareholders.
So it's not just sustaining the business, it's growing and paying out at the same time.
Precisely. It allows them to be defensive and offensive all at once, which is pretty rare.
Speaking of being disciplined, what about debt? These companies usually carry a lot of it. Their net debt to EBITDA is sitting at about 2.4x. Is that a red flag at all?
It's really not. For a company with cash flow this predictable, 2.4x is very manageable. Many of their peers would get nervous north of 3x. So no, the balance sheet is healthy, and you see that in their solid return on equity, which is at 18.4%.
And what about how they're spending that cash? I see a capital expenditure of $12.18 billion in 2024. That's a massive number. Where is that money going?
And that's the key question. It's smart money. The vast majority of it is going into fiber infrastructure, network upgrades, basically making their service faster and more reliable.
So it's a defensive move against rivals.
It's both. It's defensive for sure, protecting their broadband business, but it's also offensive. It builds future pricing power. When you have the best network, you can eventually charge more for it.
You're reinforcing the moat.
That's the play.
And for you listeners focused on income, we have to mention the dividend here.
Oh, absolutely. It's a competitive yield, right around 3.6%. And importantly, it's not a gamble. It's very well covered by that huge growing FCF.
Which brings us right to that core connectivity moat. The old story was all about losing TVV customers, but it seems like the pivot is working. Connectivity revenue grew 4.2% in Q3 to $11.5 billion.
Yeah, that's what's driving this story now. And it's really two things. It's the network investment we just talked about, and it's convergence.
What do you mean by convergence?
You're building an ecosystem. On the network side, they have the scale and quality advantage. But the tech they're putting in people's homes, like the XB10 gateway, is really sophisticated.
The XB10.
Yeah, it uses AI to optimize the network. It supports multi-gig symmetrical speeds, so super fast uploads and downloads, and can handle something like 300 devices in one home.
Wow.
So the connection just works.
Yeah.
And when it just works, people don't leave. That lowers their churn.
And that creates what analysts call stickiness. It's not just about the internet pipe anymore.
Not at all. They're creating high switching costs. Think about it. You get your broadband, plus Xfinity Mobile, plus their entertainment platform, plus Peacock.
And it all works together. It becomes a massive pain to switch any single piece of it.
Exactly. And that bundle is driving people to higher margin products. We saw almost 40% of new broadband customers in Q3 choosing gig speeds. That's a huge shift.
Okay, but let's talk about Xfinity Mobile. The growth there is phenomenal. A record 414,000 new lines in Q3 2025. But a lot of those are free lines to keep a broadband customer rate. Is that actually a profitable business?
That's the million-dollar question, and it's a fair one. It definitely started as a retention tool, but the goal is absolutely profitability now.
How do they get there?
Well, they use Verizon's network, so their costs are usage-based. But by packaging it with their own Wi-Fi, they can offload a ton of traffic, which keeps their costs down. And now that they've hit 9 million total wireless lines, they have the scale they need for it to be a real profitable business on its own.
So it's moved beyond just being a retention tool.
It has.
Okay, so that's the connectivity side. But the thing that makes this stock so different from its peers is that second growth engine, the theme parks.
This is where it gets really exciting. I mean, this is a high-growth, high-margin business that's a perfect diversifier.
The numbers are pretty staggering. NBC Universal's theme park revenue jumped 28% year over year in the first quarter of 2025. A 28% jump.
It's a powerhouse
Yeah.
that's totally outperforming their media peers. It just shows you that consumers are willing to spend big on experiences right now.
And the big one on the horizon is Epic Universe in Orlando. How critical is that for the company's future?
It's a massive catalyst. I mean, this is a key driver for the entire Comcast story for the next 5 years. You're talking about leveraging their strongest IP illumination, DreamWorks.
Super Mario.
Super Mario, exactly. This plays directly into that consumer trend of spending on experiences over goods. It gives them a growth path that, frankly, none of their telecom rivals can even touch.
But we do have to talk about the part of the business that's still in a dogfight. Peacock. The streaming service. It's still burning cash.
It is. But it has scale. It's at about 30 million paid subscribers now. And the good news is that management says the EBITDA losses are getting smaller.
What's the target for profitability?
They're aiming for 60 to 70 million subscribers. That's the number they see as being, durably profitable.
That sounds like a heavy lift in a super crowded market. So how do they get there? And more importantly, what's the backup plan if they don't?
The backup plan is the rest of the company. That's the key. Their FCF is so strong from connectivity and parks that they don't need Peacock to be a home run. For them, it's a huge potential upside, not a do-or-die bet like it is for some of their rivals.
That provides a nice safety net.
It does. And their strategy is different, too. They're focused on the ad-supported model, they have valuable sports rights, and it's all integrated into that Xfinity ecosystem we talked about.
Okay, so let's shift to the stock itself. You've got all this fundamental strength, but the share price, well, it's had a rough go. It's down 30, maybe 35% from its highs. What gives?
Yeah, that pullback is exactly what creates this value opportunity. The problem is the market narrative right now is just completely obsessed with these huge streaming M&A rumors.
Like Netflix and Warner Brothers Discovery.
Exactly. The whole sector is caught up in this high drama, high risk speculation.
So Comcast's story, which is more of a disciplined, steady execution story, it's just being ignored.
It's being drowned out by the noise. I mean, some analysis I've seen suggests the stock could be undervalued by as much as 60% based on a discounted cash flow model. That shows you the kind of disconnect there is right now between the fundamentals and the sentiment.
Okay, that's the bull case. But let's be balanced. What's the bear case? What are the skeptics worried about?
The biggest worry is still the legacy business. Risk number one is those ongoing video subscriber losses. They lost another 257,000 in Q3. The fear is that the new growth engines just can't plug that leak fast enough.
And the counter to that
is the results. The growing FCF and EPS prove that connectivity and parks are already successfully offsetting those losses. The pivot is working in real time.
What's risk number two?
Competition, in both broadband and streaming. The worry is that more competition leads to pricing wars that erode margins over the long term.
And their defense against that is the quality of the network and the bundle.
It's the stickiness of that bundle, yes. They're trying to compete on value and quality, not just on being the cheapest option out there.
We're on the thirds?
Execution. This is a big one. They need to flawlessly execute on monetizing all those new mobile lines and, of course, maximizing the massive revenue lift from Epic Universe. That's a lot of heavy lifting.
But you'd argue the early data looks promising.
I would. The wireless momentum is there, and their track record in parks gives you a lot of confidence. And really, all these risks are already reflected in the stock's low price. That's what makes the potential upside so much more compelling.
So that brings us to the catalysts. What should people be watching for in the next few months?
The first checkpoint is Q4 earnings. That'll be late January or early February. You'll want to see continued momentum in connectivity and confirmation of that double-digit growth in the parks.
And outside of earnings?
Watch the Epic Universe narrative. Management will likely be at TMT conferences in the first quarter, giving updates on bookings and expectations. That's going to drive a lot of excitement well before the park even opens.
What about the macro environment? How do interest rates play into this?
A stable or a lower interest rate environment would be a huge tailwind. For a company like Comcast that throws off so much free cash flow, lower discount rates make those future earnings much more valuable today. It really supports the argument for the stock's multiple to expand.
So if you pull it all together, what's the final thesis here? Is this a short-term trade or a long-term hold?
This really looks like a compelling multi-year holding, maybe 3 to 5 years. You have a disciplined, infrastructure-backed business model. You're basically betting on the stable cash engine of connectivity combined with the high growth upside from the theme parks.
And the idea is that the current stock price only reflects the old legacy story.
Exactly. Once the market wakes up and recognizes this powerful dual-engine growth story, that valuation gap should start to close.
An undervalued giant pivoting successfully with two powerful growth engines. The question for you is, are you willing to wait for the rest of the market to catch up to this disciplined growth story? If you enjoyed this analysis, please hit that subscribe button to catch all our future talks.